Hello, welcome to this presentation on pre-immigration tax planning for foreign investors. I'm Jacob Stein and I'm a partner at Aliant's Los Angeles office, and international tax planning is one of my major practice areas. And I represent a lot of foreign investors who are looking to immigrate to the United States. And we have to do a lot of tax planning for immigrants coming to the United States. The tax rules that exist in the United States are vastly different than the tax rules you will find in any other country. The United States taxes both its citizens and its tax residents, and I'll explain in a second what a tax resident is, on their worldwide income. Meaning it doesn't matter where in the world you generate money, the United States, once you are sort of within its clutches, will tax you. And also once you become a U.S. citizen or resident, if you die being a U.S. citizen or resident, the United States will impose an estate tax on your worldwide assets, even those assets you have outside of the United States. So you may be living now in a country that either has a system of taxation that's based on citizenship or a territorial-based taxation system. There is really only one other country in the world that has exactly the same tax system as the United States, where it taxes citizens and residents on their worldwide income, and that's Eritrea in East Africa. No one else does this. Okay? So for a lot of our foreign clients, it's very surprising when they find out that when they come to the United States, all of their holdings, all of their income becomes subject to U.S. taxation at fairly high income tax rates. But fortunately, there's a lot of tax planning that can be done before you become a U.S. taxpayer. And this planning is done in advance and it's done properly. It is quite likely that all of the earnings you will continue to generate outside of the United States will not be taxed by the United States, even after you become a citizen or a resident of the United States. And we can also do the planning so that all the assets you own in the U.S. or outside of the United States will not be subject to the U.S. estate tax, which is a 40% rate of tax on your debt. So what sort of pre-immigration tax planning work can we do? Well, first we need to figure out when is this moment of immigration taking place for tax purposes. Not for immigration law purposes, but for tax purposes. So for tax purposes, a foreigner becomes a U.S. taxpayer in one of two circumstances. One, they start spending a lot of time in the United States. This is the so-called 183-day test. When a foreigner spends 183 days a year in the United States, they become a U.S. taxpayer. And this is not 183 days in this year or the past year or the preceding year. 183 days is actually a formula that looks at the number of days present this year, last year, and 2 years ago, and it's a weighted average formula. And when we add up the formula, compute the formula, does it amount to 183 days or more? And if the answer is yes, you are a U.S. taxpayer. And what's more importantly, under this formula, you are deemed to be a U.S. taxpayer from January 1st of the year, not from the day when you exceed the 183 days. So it's a test that looks back to the beginning of the year. The other way someone becomes a U.S. taxpayer is when they obtain a visa to permanently reside in the United States, and then when they actually physically move to the United States to reside here. And the permanent residence visas would usually be either a green card or an EB-5 visa. These are visas that allow foreigners to permanently reside in the United States. So once you get the visa and you actually come to the United States, on that day you become a U.S. resident, and this is not a test that looks back. From that day forward, you are a U.S. taxpayer. So what sort of pre-immigration tax planning do we need to look at? Well, you may have today assets outside of the United States. You may own, let's say, a piece of property in your native country. This piece of property you bought many years ago. You may not even have records to show how much you paid for it, but today this piece of property is worth $1 million. So imagine you move to the United States, you own this piece of property, and at a later point in time you sell it for its $1 million value. How will the United States tax you on the sale of this $1 million property? Well, the sale of property is taxed by the United States as follows: sale price less purchase price. And that is the difference that we tax, the so-called capital gain tax. Well, if you cannot prove how much you purchased the property for, then the United States will generously allow you to claim a purchase price of 0, which means that the entire $1 million that you sold the property for will be subject to the capital gain tax. So one of the first and most important things we do for our clients moving to the United States is to take this purchase price and make it $1 million. And there are ways that we artificially are able to do that without you actually selling the property. Before you come to the United States, we can do something as simple as take this property that you have in your native country and transfer ownership to some foreign entity. Transferring the property to the foreign entity for US tax purposes will increase the so-called tax basis to the $1 million, to the current fair market value. So when later you sell the property, no capital gain tax. Other things that we do other than increasing basis and establishing basis in assets for tax purposes is maybe set up ownership structures for your foreign assets so that when these assets continue to generate income, you are not the one earning that income. Maybe this income is earned by a family member outside the United States. Maybe it's earned by some sort of a corporate or trust structure that we have established. We also want to make sure that if you have existing corporations outside of the United States, that those corporations are recapitalized to eliminate any existing earnings and profits, which the United States will tax once you become a US taxpayer. And finally, for US estate tax purposes, today, before you become a US tax resident, we can take all of your assets, whether it's $1 million or $500 million, and we can move these assets to your children or to a trust for the benefit of your family. And once these assets are out of your hands, so to speak, the United States will not impose an estate tax on those assets on your death. I'm Jacob Stein. Thank you for listening to this brief presentation on pre-immigration tax planning.